I said, the month of May has generally been a good month for the US currency. We've seen a strong recovery, which has been dominant in currency pairs like euro dollar and dollar yen, those that are heavily weighted in the dollar index. So, with regards to the reasonings behind that, we've seen a bit of a technical correction unfolding. As I said, we've seen that strong bearish pattern since that attempted recovery back in February. But if we're looking at the wider picture, a lot of that negative momentum in the dollar had come from the beginning of October last year. Remember, 2022, for the first 9 months of the year, was a very strong year for the US dollar on the back of that very hawkish Federal Reserve and those tightening of monetary policy conditions. Well, we got to October, that started to change. We started to see the end or potential end of rate hikes, which fast forward to now, we're not entirely sure yet when that is. But nonetheless, markets are starting to acknowledge the need to start considering the end of the hiking cycle. And that weighed on the dollar. Again, a bit of a technical correction from that strong move that we saw throughout the beginning of 2022. Now, at present, we have a few factors unfolding. Of course, one of them being the general sentiment in the market. We know that the dollar is a good safe haven when investors are looking for a safer place to place their capital, and they're not necessarily looking at a commodity like gold. Then they're essentially looking at the US dollar in the currency space. So there's been a lot of uncertainty recently as to what we can expect in the next few months in the economy. Are we going to see a recession? Are we not? That, of course, plays a little bit of a factor in the demand for the dollar, but also the debt ceiling situation, which has been unfolding, which on the first glance, you would expect the fact that the US government was battling to avoid a default on its debt, a compelling reason to buy into the dollar. But again, it brings out that need for investors to assess their portfolios, their risk management strategies. But also in the last few weeks, we started to talk about a deal for this debt ceiling impasse, and over the last 2 or 3 days, a deal to suspend the debt ceiling has been formulated, and yesterday it got voted in the House of Representatives and it got passed through the House. So essentially bringing a little bit more safety to investors, and I think we've seen that in the stock market. The stock market has been rallying this week. It's been very, very strong, of course, led by the tech sector and AI and Nvidia, but nonetheless, this potential removal of this risk factor, which is the technical default in US debt, being removed has helped investors gain a little bit more traction, a little bit more risk on sentiment, and that weighs on the dollar as well. So that rally that we've seen throughout of May seems to have started to stagnate a little bit, and of course this suspension to the debt ceiling seems to be one of the cases. It still has to be voted in the Senate on Friday, so anything could happen really, but it's expected it will pass through there easily as well, and it will be approved, and therefore remove a layer of risk from the US economy, and therefore potentially keep the dollar subdued in the short term. Another factor, of course, is what has been driving the dollar demand for the last year and a half, and that is the monetary policy. What's going to happen in the meeting in June? Are we going to see a rate hike? Are we going to see a rate hike pause? What are the FOMC members going to say about the economy? And it's been quite volatile within itself, the market expectations about what's going to happen. So we started off the month of May, or since the previous meeting at the beginning of May, with a 90% chance that we were going to see no hike in June. That has shifted quite dramatically to the point where last week it was around 60% of yes, we are going to see another 25 basis point hike. That was on the back of Fed speakers in the previous 2 weeks being quite hawkish and still saying that, look, inflation is high, the labor market's tight. Do we see a reason to stop hiking just yet? Not necessarily. So that shifted expectations. Today, we are back to 63% chance of no hike. And that is on the back of 2 Fed members coming out and saying that maybe they should skip hiking rates in June, which is not the same as a pause. It's suggesting that the hiking cycle isn't over yet, which a pause could indicate that it is potentially. So we know it's not over because we know we're going to hike at least once more, but just not now. Let's just wait and see what's happening, and we'll do it potentially at the next meeting. So it's not a definite there will be another one, but it definitely implies a lot more probability of there being another hike compared to a hike pause. It may be very confusing, but it is all about the semantics and the meaning behind all of these comments. So the fact that two Fed members suggested skipping a rate hike at the meeting in 2 weeks has weighed on the dollar a bit as well. Of course, it's weighed on US yields too, and also the debt ceiling deal has also weighed on yields, reversed a lot of that strong momentum we've seen, which again we know goes in hand with the US dollar. So that is what we've had. But also there's the hawkish FOMC members, which are always there, and one of them being Loretta Mester, and she came out yesterday saying that she sees no need to wait for a hike. So no need to skip one and then hike at the next meeting. Let's just do it now. Let's get it over with. Inflation's still high. We need to combat it. So look, there's opinions on both sides of the spectrum within the FOMC, within the Fed, in the market in general, economists. So it's a very uncharted territory at the moment. No one really knows exactly what's happening. But of course, we have data coming out, and one of them being tomorrow, the FOMC, so the NFP data and the unemployment data for the month of May. We know that one of the sticking points for the Federal Reserve has been the labour market. The fact it's remained so tight. Unemployment dropped unexpectedly last month when markets were anticipating a small rise in unemployment. It's very tight. Wages are still high. So, the Federal Reserve wants to know that we are starting to see an economy that's shrinking slowly, which will effectively bring down inflation nicely. We haven't quite seen that yet. Are we going to see that now? Who knows? So watch out for the NFP and jobs data tomorrow. That I'm sure is going to have some volatility in the market, impact the decision. But at this point, I think there's compelling reasons for both theories within the Fed. There's compelling reasons to stop hiking and wait to see what the impact of previous rate hikes are. There's compelling reasons to continue hiking to make sure that, the economy is in check before inflation gets out of hand again. So who knows? But that is definitely what's been determining momentum in the dollar over the last few days. As I said, there is a little bit of stagnation in that rally. So let's jump onto the charts now to see how it's trading. Okay, so here we have it. We're on TradingView, Capital.com charts. This is the dollar index chart, the daily time frame. And as you can see, the month of May, a pretty strong month for the dollar index. As I said, not since February we've seen such a strong momentum. Started to stagnate there. I think on Friday last week, we already saw indecision creeping into the market, as you can see. Those longer wicks, pretty much an inexistent body, really showing the lack of momentum to take the currency anywhere. As you can see, we've started to see those hanging patterns where we're seeing that upper body, but essentially that upper wick, but the body coming close to the lows of the day, struggling to find buyers to really take that the asset further, struggling to find buyers to keep that momentum at the highs for the day. So essentially indicating that weakness in the short term there. The RSI also very close to that to overbought territory. So again, it's just a situation where I don't think anyone's really sure right now as to what's going to happen. The debt ceiling deal seems to be more or less out of the picture now. We seem to have got that under control. The momentum for yields really shooting up seems to have started to diminish. That, of course, is remove some of the support for the dollar. Is there a compelling reason to sell the dollar at this point? I don't think so. We're still within that technical correction. If we compare where we were in September, October last year, we're still about 50% lower than where we were. So I don't think there's a strong compelling reason to sell the dollar either. I think investors are still trying to manage the risk in their portfolios to some extent. As I said, there's still a lot of uncertainty and decision what's going to happen with interest rates. So I think there's no compelling reason to sell from this point, but I think we're also struggling to find further momentum. So I wouldn't be surprised if we see some sideways consolidation over the next 2 weeks, some tight ranges, potentially some bursts here or there, as we react to further comments from Fed members or potentially some developments with the debt ceiling deal. But I wouldn't be surprised if it's a tight range from here. Now let's take a look at the euro dollar. As we know, one of the biggest components of the dollar index, and you can see here that a dominance of the dollar really weighing on the pair, coming down to a 2-month low, 2.5-month low, just shy of that 106 area at the moment, which is roughly where that 38.2 Fibonacci would be. Again, starting to see some buying interest coming in. The opposite to what we've seen in the dollar, you can see the body there close to the upper part of the candlestick, suggesting that sellers are now struggling to continue pushing lower. Buyers are coming in. We have a little bit more support in place. I do still think we can retrace a little bit further, and I think if you're looking at areas of support, back here just around that 105 area, I think it's quite a significant level to watch out for. We've seen some support in the past when we've seen that sell-off intensify. So again, we could still pull back another bit to 105. We've also got the 200-day simple moving average coming in close there as well. But other factors taken an eye out for with with euro dollar is Eurozone inflation has actually come in lower than expected, which is a good sign. In individual countries, they are falling quite significantly, which is definitely good for the European Central Bank, which is adamant that they still have to continue hiking rates. But also, Germany has now entered into a technical recession. The biggest economy in the group has entered into that recession. So, of course, that is likely weighing on sentiment for Eurozone assets. So I wouldn't be surprised if the short-term bias continues to the downside, but I would expect that support around 105 to continue to play its part if we don't manage to reverse momentum at the current level, just around 107. Another quick pair to look out for before we finish is dollar yen. Dollar yen, again, the dollar outperforming, really taking advantage in those differentials between the Federal Reserve and the Bank of Japan. As we know, the BOJ continues to remain dovish, although we did see some comments from the new governor suggesting that maybe some action would need to be enforced if inflation continues at current levels, which is probably the most hawkish they've been in a while, but nonetheless, still very underwhelming compared to other central banks. So that really taking hold of dollar yen, coming to rest here, a high that we haven't seen since the end of last year, since around December 2022. But again, finding a little bit of resistance there to push higher. Of course, that weakening of yield weighing on the US dollar. I don't think we're going to necessarily drop back into this triangle pattern, but if we do, expect to see some support along the way. I don't think we've fully reversed that momentum yet. I don't think it's a clear seller's market either. But I think just a little bit of undoing some of the strong bullish momentum we've seen, a little bit of sideways consolidation, seeing as to what's to happen and where the support comes in for the next move higher.